Welcome to Bloomberg Markets. I'm Sonali Basak. U.S. economic growth slows and inflation persists, setting jitters across markets and once again pushing back the timing of the first rate cut expected out of the Fed. Let's get a check on these markets because you are seeing a steep drop lower. The S&P 500 down more than 1%. The Nasdaq 100 that started the week on a high note now down about 1.4% on the day. The Dow Jones Industrial Average also down about 1.5% on the day. The VIX marginally on the rise. Let's flip up the board here and take a look at yields and where they're headed because you have traders recalibrating their expectations and the two-year yield just a touch under that 5% level once again. We have been seeing massive volatility in the bond market, of course, on a week with a lot of auctions as well. The 10-year yield now at 470 on the day, a 6 basis point move higher. And New York crude hanging out around $82. That is 0.3% lower. Gold, once again, on the rise, has been a favorite asset for traders all year long, about 0.5% higher. Some midday movers here on the equity side here, flipping up the board. We're going to start with an economic bellwether, Caterpillar, reporting quarterly sales slipping from a year earlier. The company warning that the trend is expected to continue in the second quarter. Caterpillar told investors in February that sales would be largely in line with 2023, but that now seems to be shifting. The company has beat expectations in almost every quarter since 2020. And we're going to talk more on the equity side here because in addition to that 7% drop in Caterpillar, we're looking at Meta intraday also dropping pretty dramatically, tumbling more than 12%, almost 13%. The company announced that it will spend billions more than analysts expected on its AI efforts. Mark Zuckerberg is asking investors for patience. They are not too patient today. Zuckerberg saying that the futuristic technological bets will eventually pay off. Bloomberg's Abigail Doolittle has more on Meta and the downward pressure across tech.
Yeah, it's interesting to see that plunge today, Sonali, the worst day since October of 2022. And I would argue some of it has not only to do with the fact that the guide a little bit light and also a bigger spend for AI. Take a look at the shares of Meta here in this Bloomberg terminal chart in white up top. At one point, up more than 40% this year alone. Over the last year into this quarter, up about 130%. So price to perfection, investors simply did not get that. So you can see the big plunge. Now, what we have here below in yellow and green, Microsoft and Google both up. We have Microsoft up about 5%, Google up about 11%. Actually, let me make sure that is correct. And then Tesla coming off of its bottom after a little bit of hope around the cheap EV. But my point here is, again, Meta price to perfection coming back to earth. What's ahead, though, for Microsoft and Google? Because that result for Meta, that big AI spend, really weighing on both of these shares. Microsoft having its worst day, I believe, since October 2022 or January 2023. So more than a year, depending. So key for Microsoft will be where earnings and revenue come in right now. Analysts are modeling mid-teens growth, which is pretty solid. The bigger deal, though, could be Azure, that cloud growth. Will it come in at 28%? And then, of course, the AI Copilot. What is that revenue spend going to look like? Some analysts are saying that it's going to be talked down. One analyst saying that for Microsoft, it's all about surviving and advancing. That may be the case for Alphabet, too, given this tough tape relative to Meta. If we take a look at for Google, they have an unusual circumstance relative to some of these other big tech companies. You can see solid, okay revenue growth over the last few quarters, but into this first quarter of 2024, down 5.3%. And that's not even expected to end, Sonali. Take a look at the June quarter. That's also expected to be down about 3%. So they will be talking about that to some extent. Will search hit the 11% growth metric? A lot of analysts are saying not, but maybe pricing and query volumes could offset. And then it's going to be all about that cloud and AI, the AI spend and cloud. They could see some sequential revenue growth. Some analysts are saying a little bit of hope there because of the AI workload.
Thank you, Abigail. We're going to now talk about a different part of the market, a big move on Wall Street happening right now. Cantor Fitzgerald has got the backing of major names on Wall Street for its upcoming new futures exchange, FMX. Investors from Bank of America, Barclays, Citadel Securities, Citi, Goldman, and JP Morgan invested more than $170 million for a nearly 26% stake in FMX, which will increase as they keep using that platform. We're going to bring in Cantor Fitzgerald Chairman and CEO Howard Lutnick. You've talked a little bit about this before, this idea of taking on CME in the futures business. How do you take on a giant today with the help, frankly, of every major Wall Street bank?
All right, so BGC Group, public company, owns this exchange, right? And so we are the wholesaler of the world. So you think when Fidelity or PIMCO, when they wake up in the morning and they want to buy something, they call a big bank. Who do those banks call? Like, what do they do? So BGC Group is the broker in between. So we're sort of the exchange for everything in the world that doesn't trade on an exchange. And everybody always asks me, if you're the exchange for everything that doesn't trade on an exchange, why don't you become an exchange? So BGC set up FMX to build a futures exchange to compete with the incredible monopoly of in America, the Chicago Mercantile Exchange, which is awesome. It's worth $80 billion and stands alone, did 99% of futures in America last year. It seems like a monopoly to me. So all these banks came in as our partner. 10 of the greatest trading firms, 1 through 10, JP Morgan, Goldman Sachs, Citigroup, Morgan Stanley, Wells Fargo, Barclays. I know I'm going to leave someone out. It's great. Bank of America, Citadel, Jump Trading, the number one futures trader in the world. Tower, number one treasury traders. These all are together, all coming behind this exchange to make this exchange so fun and so amazing.
Well, here's the question. If CME, as you say, has 99% of the volume here, how come these banks have supported you in this? What is the outcome that you and them are looking for?
Well, look, when you're alone like the CME, they do, as I say, they have a great product and they charge a great price. Like, holy moly. And sort of like at every Christmas, they just raise their price. Hey, it's a Christmas present. Let's just raise our price. So the banks want an alternative. They want a competitor. And what else they want is innovation. So we have the fastest system, right? The tightest spreads. And we did this in U.S. Treasury. So we started with the U.S. Treasury. Now, the CME had, when we announced that we were going to be in the U.S. Treasury market, like an exchange, they had 85% market share, the CME. So I call them the heavyweight champ. Right? And there was 15% by other players. So we went in, we now have 28%, and they're in the mid-60s. So if someone thinks we can't get a glove on the champ, they're wrong, they're not watching. So the Treasury business was one. Now we're going to do Treasury futures. You might say, well, why shouldn't you win in that as well? And the answer is, I think we're going to. And we're going to do SOFR futures, which are like interest rate swaps. And that's going to be amazingly cool as well.
You've been talking about this interest rate business, treasuries in particular as well. Are there other markets that you would look to break into that you're not currently in?
Well, we're going to start with the interest rate world. But when you've got the world's greatest trading firms as your partner, they're going to say, what's next? And I would think other futures exchanges to start will be a classic move as we go around the world. Equities, bonds. It's a futures exchange. You can do anything. So it's really fun. We have the technologies already in place. See, the thing about BGC Group is it already has the connection to all these people. We don't have to start building it today. We're going to open in September, right? And we're going to start, and with a futures exchange, you just want everybody to connect. So the first year, we're going to get everyone to connect. Second year, we're going to get everyone trading. And in the third year, it's going to be full-blown, full-on competition for the $80 billion heavyweight champ.
We'll talk about that timeline in a second, but you had mentioned the Christmas present of higher fees from the exchanges. Do you plan to lower trading costs on this new venue?
Would the word for certain be helpful? Yes, absolutely, absolutely, absolutely. The concept of being much more efficient, much faster and much cheaper will create more volume, will be innovation, we'll do all sorts of things. We'll build, as an example, if you want to trade one futures contract against another futures contract, it's built into the trading system so you can't miss. It's atomically built in rather than two different systems sort of trying to figure it out. I mean, you can just be innovative, clever, smart, and faster. And the banks are all behind us. The greatest traders in the world behind us, the greatest technology that's already installed. I think if I don't seem like I'm having fun, you just haven't spent time with me. This is so much fun for us.
Howard, today it's valued at $667 million with the new backers that you've brought on board. You've kind of mentioned a 3-year timeline to expand the business. What is this company valued at in 3 to 5 years?
Well, it's sort of like one of my favorite thoughts is when George Clooney tasted some tequilas, right? And he bought a tequila company. How much was that tequila company worth? I think he bought it for like $7 million. And then he sold it for $700 million. So these banks are my George Clooney. You know, I see them, I'm like, these guys are just so, these men and women are just so handsome.
Do you have a goal? Do you have a target on how big you want to get?
I think we want to gain market share like we've done in U.S. Treasuries. Our U.S. Treasury business, which competes with the Chicago Mercantile Exchange, grows 1 to 2 points market share every single quarter. So we were 26% at the end of the year. We just put out this morning with you guys 28% this quarter, so 2% per quarter. I think we're going to keep growing. We'll get to half, and I think our futures exchange will just keep growing, and eventually we'll get to half. And I think that eventually will become enormously valuable for us, for competition. It'll drive down costs. It'll drive up volumes. It'll be great for America.
It's interesting to hear you come in and talk so much about growth, because when you look across Wall Street right now, it's hard to find a lot of growth, particularly when it comes to headcount and expansion. What does this mean for all of your companies, Cantor Fitzgerald, BGC, in terms of what you want to be able to do? Bring more people on board? Is that possible for you?
Sure. I mean, when you're innovative, you can create new things. So we're hiring tech people up a storm. BGC is growing amazingly. A stock was up. BGC Group was up 90% last year, and it's on a tear again. And it's going to be. Imagine you have this exchange where all these banks bought in at a $667 million valuation. But that was yesterday. What do you think it's worth today with all these banks as your partners? Multiples and multiples higher. I'm sure private equity firms would love to invest at 3 or 4 times that much. We aren't sellers. We're going to build a great business. BGC is growing up a storm, and so is Cantor. So I think there's lots of growth ahead.
So let's talk about the markets now, too, because you're in the Treasury business. Of course, we have the two-year about to touch 5% once again. A lot of expectations changing in this market. Treasury auctions coming at really a record clip, almost across the curve. What kind of volatility does that create, and where do you think the Treasury market really goes from here this year?
All right, so you have 2 things that are incredible to think about. The Fed's balance sheet is $7.5 trillion, and that's got to come down. So that means they're not going to buy the treasuries. They need someone else to buy them. That, coupled with our beautiful government running deficits of $1.8 trillion a year, so you've got just huge supply coming. That's got to keep rates higher for longer.
How
it
high?
has to keep rates higher for longer. I view it as steady, right? When I was here in January with you guys, I said rates would be steady. And where have they been since then? Steady. Remember people were talking about 6 or 7 cuts? I was like, ha, ha. Like, who's cutting 6 or 7 times? I think the Fed is going to stay steady. I think inflation is stubborn. We're hanging in there. You're seeing the 2-year note. Think about this. The market is saying 2 years at 5%. So what's the core market really saying? They're saying we're not really going anywhere, right? What short-term rates are at 5.25. So if you said the average for the next 2 years was going to be 5%, right? What you're saying we're going to stick around here, and we are. So the Fed has the ability to cut a little. Because remember, if they let go of their balance sheet, that's tightening, right? I'm not buying anymore, you're going to buy. That's going to take money out of the system. When the Fed stops buying and cuts its balance sheet, that's a tightening. So the Fed can cut a little bit of interest rates.
When's that first cut?
I think right before the election. Not that the Fed is involved in elections, but September? I'm thinking September, and it's not really to move the economy. It's to show off a little bit, help a little bit. You know, the guy who's employing you today, maybe he'll give you your job again if he gets elected. Can't hurt. So I think September, 1 cut. That's it. Just show it off. not really doing it.
Really curious about your views on the election here, too. Earlier this month, you hosted a fundraiser for Donald Trump alongside John Paulson in Palm Beach. What would a potential Trump presidency, Trump 2.0, what would that mean for the markets?
Well, again, last time, if you remember, there was a lot of consternation when he was elected. And my view was it will be good for business. It will be good for the banks. And it was. The banks traded incredibly well. You know, the Republican Party is a less regulatory party, right? You saw the Federal Trade Commission just came out and said non-competes are something they want to do away with. That's not really business friendly, right? So an administration that's more business friendly probably is good for stocks, although you can't say lately Joe Biden's not good for stocks. The market's doing perfectly fine and stocks are doing perfectly fine. So I think it's not going to be as much as people think, but I think a Trump administration is just less regulatory, which businesses like, less like with the Federal Trade Commission saying non-competes, they got sued right away. So it just seems overbroad. Less regulation is good for markets, good for business, and I think businesses like that better.
Well, what do you think this means in terms of the attitudes from the business community around Donald Trump? Do you think that there's any changes that you've seen, particularly given that you have such a close ear to the ground?
I think you feel more coming. I think they were afraid in the beginning. I think when it was still during the primaries, but you feel more and more people coming. Surprisingly, people who would never have said that before come up to me and say, I'm thinking about it, because they really don't like immigration. I mean, immigration is just something like, who talks about immigration at dinner parties? The answer is these days, everybody talks about it. I mean, you have it in New York everywhere. You have it in San Francisco everywhere. So immigration matters. And just the things like today with the Federal Trade Commission. I mean, it's just big regulatory push. So I think business is moving more towards the Republican side, surprisingly more towards the Republican side than they were before. But I think it's going to be a tough fought election. I really think it's going to be dead heat close.
Dead heat close. How do you think that translates to volatility into the markets throughout the year and into next, even, given the challenges you're seeing around the world and given the challenges you're seeing in the U.S.'s own economy starting to come up? I
think big volatility come the end of September, going into the election. I mean, the uncertainty. Well, investors tend to put their hands in their pockets when they don't know what's going on, right? When you have a good confidence of where you're going, in you go investing. So I think volumes will decline a bit and volatility will rise because people won't know which way they're coming or going. So I think October is going to be just a crazy time because people won't know what the heck is going on. And the election, what's amazing about elections in America, once it's settled, markets go right back to normal. So I think once it's settled, I think you're going to have a much better market than you're going to feel in October. Another volatile asset, Bitcoin. You have been very vocal in your kind of constructive view about Bitcoin, particularly as it's used around the world. Interesting, though, you did say that it would be benefiting and rebounding this year, but you didn't say that the ETF would necessarily bring it there. Would you be a buyer of Bitcoin at these levels? I think so. Bitcoin just halved. Right? Which means that the work you do to get a Bitcoin, the price is twice as high. So that is theoretically a benefit for the next 4 years for Bitcoin. So I think over time, Bitcoin will rally even from here over the next 4 years. So if you bring me back 4 years from today, I think the market will be higher. And I think these things, it has a place in the world and it's not going away. So I think that's sort of the way to think about it. You've spoken about your optimism around Tether as well. I'm curious about your view on this because recently S&P analysts have said if the latest U.S. stablecoin bill passes, that U.S. companies would no longer be able to hold or transact in Tether because it's run by a non-U.S. entity. How do you prepare for something like that? Well, I think, first off, Americans, stablecoins in general, there's two big ones. There's Tether and there's Circle, okay? And Americans should have nothing to do with these things. I have dollars in my pocket. I have dollars in my bank account. I have a credit card in dollars. I can Venmo you, PayPal, Zelle. These are all simple things for Americans. We have no business being near stablecoins. But I tell you what, Argentina Turkey, Venezuela. If our money, right, if our bank account, we woke up with the Turkish lira, which was down 65% last year, we'd be doomed. So you want to hold the digital dollar. So that's where Tether really flourishes. It's in the emerging markets. So the concept of trading stablecoins in America, I just don't get it. So I don't think it has anything to do with America. I think what we care about as Americans is that the dollar is all powerful in the world.
Do you worry ever that there could be the use of Bitcoin or Tether being used to evade U.S. sanctions, given the use of it around the world, particularly coming out of Russia?
I think the key to digital is that it's always digital. You know, dollars, you remember when we went into Iraq, they found like rooms of $4 billion on pallets. That you can't trace, but digital money you can trace. I think the firms like Circle and Tether have to work deeply closely with law enforcement and grab it. Because remember, these are digital money. All they can do is move around, and the blockchain always keeps track. So think of the AI and think of the tools the government's going to have. They are going to get better and better. The way I describe it is government moves reasonably slowly, but it always gets there. Sooner or later, it'll get there. So they'll have great AI tools. They're going to use their AI tools. Any criminal who wants to use Circle or Tether is going to get caught. It's going to get seized because it's digital. So it means you can't really hide it. It's on the blockchain. You can follow it from here to here to here to here. So I think it's good for news to say, oh, they're using it like this and this, but they're all going to get caught. They're all working. Tether and Circle are working closely with law enforcement. And these crooks are just, it's so much worse than a regular dollar. At least a dollar in their pocket they can hide. How can they hide a digital dollar? That's a joke.
Howard, we thank you so very much for breaking your big news with us. Congratulations on getting this venue off the ground and for all of your candor. That is Cantor Fitzgerald, Chair and CEO Howard Lutnick. Stick with us. Much more news ahead. This is Bloomberg. The latest GDP data sending yields to the highest levels of the year as traders now expect the Fed to cut rates, possibly in December at the earliest. Bloomberg Sydney Maki joins me now to discuss the changing expectations. Why was this GDP data enough to start moving the needle in terms of where Fed swaps have been moving to show these changing expectations?
Absolutely. So it's interesting because the data that we saw come out this morning not only showed GDP, but also a core underlying inflation gauge. And that is really what the bond market focused in on. So we saw this move higher in yields. We saw the rout in treasuries continue in the wake of that data. And it goes to show that if you're a bond trader on Wall Street right now, it is extremely difficult to ignore the repeated evidence that we've seen coming from economic indicators that shows inflation is rather sticky in the US. And that makes it more and more challenging for Federal Reserve officials to end up cutting interest rates. At this point, we saw swaps traders this morning go ahead and push their expectation for the first fully priced in Fed rate reduction to December. Before the data hit, it was in November still.
How do you feel about the upcoming economic data? We still have PCE before we see that big Fed meeting next week. How do traders really think about this volatility and how to reposition?
I think it depends on what the data shows. Of course, Fed officials have come out and repeatedly said that they have little choice but to be data dependent, that they are watching the indicators very, very closely, and the market is doing the same. So with PCE tomorrow, of course, that will set the stage for next week's Federal Reserve meeting, as well as Treasury refunding. And we'll have employment data come out next Friday, which will once again give us a good gauge of how the labor market has been behaving and whether the Fed can truly go ahead and rein inflation in enough that they can reduce interest rates. The timing, of course, gets more challenging for a rate reduction the further into the year we get. We have elections and other complications that just up the ante and the focus on when exactly these rate cuts will come.
Sydney, we thank you so much for keeping an eye on all the moves in the bond market. That is Sydney Maki of Bloomberg News. We're going to talk more about the economy and markets up next with Jim Bianco. Of course, we are seeing a stiff move downward in the stock market and, of course, a sharp move higher in yields. Stick with us. All of that ahead. We will make sense of all of it for you. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak. Let's check on these markets because, of course, we're still heading lower. You have the S&P 500 not as low as it was before. We are off the lows of the day, but we are still above 5,000, and we are down now 0.8%. NASDAQ 100 still maintaining its losses of more than 1%, as is the Dow Jones Industrial Average. VIX slightly on the rise. Let's take a look at yields, though, because this is where you're seeing the big sell-off. The two-year yield, you're looking at just under 5%. You are looking at a 6 basis point move higher after that GDP data, and you have the 10-year yield now at 4.70 on the day, also 6 basis points higher. Crude taking a leg lower, down now 0.3%, and gold spot on the rise once again. Some midday movers on the equity side. Let's look at Southwest Airlines, slowing growth, ending service at 4 airports, and offering voluntary leaves to address significant challenges stemming from reduced deliveries of Boeing planes. The carrier said that it would end the year with 2,000 fewer employees than in 2023, and flying capacity growth will decline to 4% in 2024. Southwest now down almost 7.5%. Micron was awarded $6.1 billion in grants and as much as $7.5 billion in loans to build new factories here in the United States. The chip maker pledged to invest about $125 billion to build 4 factories. Intel, TSMC, and Samsung are also getting grants from the CHIPS Act. You now have Micron up about 0.2%. And then, of course, Hertz shares lower after reporting a loss that was nearly 3 times worse than analysts expected. Its accelerated sales of EVs to reduce its fleet of Tesla models have weighed on profits for the past year. We have Hertz really now down about 18% on the day or more. Back to the economy, though, because strong consumer demand and muted price pressures that had fueled optimism for a soft landing are beginning to sputter because first quarter GDP growth grew lower than expected. Here's what Stifel CEO had to say about the latest data.
I think that the fact that we believe inflation is going to prove more sticky than it has, sticky for us would be that the Fed's preferred measure, which is core PCE, it may settle at 2.5 versus 2. And the Fed's not, I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky.
Jim Bianco is the president and macro strategist at Bianco Research. He joins us now. Jim, how do you take a look at the data this morning, knowing that we have more data to swallow ahead?
Yeah, the headline number looked a little bit weak, but when you look underneath it, a lot of it was trade and was inventories that dragged the economy down. So the traditional measures of spending have been there. And then it was the inflation numbers. They were above consensus. 3.7% annualized rate for the personal consumption deflator. And that's a problem because it's suggesting that the economy is not slowing enough, if it's slowing at all, that it's bringing down inflation. And that inflation is going to continue to stay a problem. And that's what I think was the primary catalyst for bond yields to hit a new 6-month high today.
Well, you look at the 2-year alone and you see it just nearly touching 5%. It's just trying to break into that level. How do you think that this kind of changes the calculus around how people are willing to trade this bond market?
Well, I think the problem you're going to face, especially when you focused in on the 2-year correctly, is that we seem to be pushing out the rate cut all the way to December. Well, that's the process maybe of bringing a rate hike in, because if you don't bring a rate hike in, there's a very limited amount that the 2-year yield can go up. I mean, if the Fed's not going to raise rates anymore, it could still go up some, but not a whole lot. And if the economy is not slowing, that could actually become somewhat of a stimulus for the economy that you might need even higher interest rates. But that said, I do think that you're going to probably see rates head higher but not as much more from here. To use a baseball analogy, probably in the 7th or 8th inning of this rise in rates. And if you know baseball, a lot can happen in the final innings of a game, but you're getting towards the end of this move right now. And it could be very painful, especially for risk markets like equities, because as rates went above 4.5% in the 10-year note, the stock market has really been struggling. And if it goes to 5, it's not that far away right now, I think it's going to continue to struggle.
How much would it struggle from here, and which assets struggle the most in that scenario?
Well, let's go back to last year. From July to October, the 10-year yield went from 3.80 to 5%. The 10-year, the S&P 500 corrected 10%. It's gone from 3.80 now to 4.70 in this move, and the S&P's corrected 6%. It's almost like it's a complete overlay of last year. So if you just follow that, you can have another 10% correction. And look, we're more than halfway there as well. And what typically has been really the interest rate sensitive sectors, the smaller cap stocks, value stocks that matter more for interest rates seem to be struggling a lot more. I know that today, you've got Meta and some of the other big Magnificent Seven stocks really struggling on the back of those earnings, but it will be a big headwind for the stock market, these higher rates.
Speaking of more stocks here in the middle of earnings season, you saw such a big shift in sentiment heading into this week. So much optimism. There were days where every Magnificent Seven stock was in the green this week. And now you look at today and there's a very different story going on. How do you really handicap how to feel about big tech in this environment?
It's funny you brought that up because I noted that too, is that by Tuesday's close, 2 days ago, it was like everybody's like, the stock market's on its way. It seems to be doing well. And I was like, did we memory hold last week? It was the worst week in a year. Did we memory hold the 6% correction? We're not near the all-time highs in the stock market right now. And then reality hit us yesterday, and reality is hitting us a little bit more today, that this is a correction and that there is some headwinds that the market has to face. And we're going to have to basically I think we're going to have to reassess our views about big tech, and I think we're going to have to reassess things. Now, that's not to say the market's going to go down, but we had a straight line 28% rally for 6 months in the stock market. That's extraordinary. That's already happened. Now we're in a correction stage. Now we'll probably hold most of those gains, but if people think that no, it's supposed to straight line 28% all the time, you've already had it. And if you didn't capture that one, there's probably not going to be another one like that for a while.
Hey, Jim, how do you think about the potential at this point, not about rate cuts, but around rate hikes? If you think about the risk that you kind of presented earlier, it's the risk that rates go even higher from here. What are you watching to kind of gauge how big that risk could be at this point?
So you've got one rate cut priced in for the year, down from 6 a couple of months ago. I would probably say that the probability of a rate hike is above 0, but it's not above 50%. So, none are priced in, but you're leaning that way. All year, we've seen beats in payrolls and in CPI, retail sales, and a lot of the big headline numbers. If we continue to see beats, that probability of a rate hike will continue to increase. But let's throw the calendar in there, too. It's an election year. These numbers could massively beat, and the Fed is not going to raise rates if that's warranted, until the end of the year. And the problem that they face is if it's warranted sooner, they're going to probably stall because of the election, and that could actually overstimulate the economy. So we better start seeing some slowing in the economy here real soon. Otherwise, this rate cut will become a rate hike, and it will become a rate hike months away because of the election, and that could be very problematic.
Well, what do you think about the potential for things to slow a little faster than people expect? Thinking back about this GDP data and the mixed bag you're really getting with the idea of slowing GDP but still persistent inflation. And you wonder whether rate hikes at this or rate staying stable at this level, at what point does that ripple effect start to weaken things faster, perhaps much faster than many are expecting right now?
Well, if you look at the GDP number, what you saw in it was a weak government number. It only added 0.2 to the overall 1.6% number, where the government has been adding a lot more than that. Now, the government has not found some austerity program that is going to rein it in. You're probably going to see either revisions to that number or a big bounce back in the subsequent quarters of that number. Same thing with trade and exports. They dragged down GDP by 1%. They had been additive to GDP in the quarters coming in. That's going to come. So what I'm trying to say is that you take a look at those numbers that drag down GDP, and the consumer spending numbers are staying relatively strong. I'm having a hard time seeing where that slowdown in the economy is going to come. Oh, it will slow a little bit, but probably not enough to rein in inflation. Today's number is a good example of that. 1.6% headline did not comfort the bond market that we were reining in inflation. And so if we continue to see stronger numbers, we're going to continue to see higher rates, probably pushing through 5%, and getting everybody all worked up that inflation is a real problem.
Jim, we thank you so much time for such a sober view on these markets. That is Jim Bianco, president and macro strategist at Bianco Research. Now, coming up next, more earnings. Royal Caribbean CEO joins us to discuss travel, consumer demand, and the latest earnings results. Stick with us. Looking forward to that conversation just up next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for the stock of the hour. Royal Caribbean shares moving higher after the cruise operator boosted its full-year profit forecast, and demand for cruises continues to surge. Let's discuss this with Royal Caribbean CEO Jason Liberty. You know, it's interesting, Jason, because a lot of folks look at the cruise industry, this tremendous rebound since COVID, and this idea that, yes, a lot of people have come back. You boosted your forecast. A lot of people are coming back. How convinced are you that this boom can keep running, and at what pace?
Well, first, it's great to be here, Sonali. Thank you for having me on today. Obviously, we feel really bullish about the demand that we're seeing from our customers and the sustainability of that demand. And I think it's in a few different ways. One of which is the cruise industry is it's about $65 billion a year in revenue, and that's a fraction of the $1.9 trillion travel economy that's out there. And so we think that this is just because we're just such a small sliver. There's just a lot of opportunity. Then when you kind of get into consideration to how we trade versus land-based vacation, there's still a pretty steep discount or value play on a cruise. But when you start getting into the demographics and secular trends, on the secular trend side, you've seen now experiences outpace spend on stuff, and that rate has increased twofold coming out of COVID. So people are looking for experiences, multi-generational travel, which very much supports the demographics that are going on. And we happen to be in the experience space. The last point I just want to make on the experience side of it is that one of the things that you really see is that our guests are looking to walk away with great experiences and great stories. And we really have focused our business on making sure that we're competitive to land-based vacation. And we're closing that gap to land-based vacation on both a pricing standpoint and also beginning to pick up on gaining share from land-based, which is a very high priority for us.
As you have new customers, something I've been wondering about is how much you have to outlay to support those customers. You know, I hadn't really thought about this before, but Royal Caribbean must be buying an insane amount of lobsters and bananas. I mean, how are you spending these days, and how is inflation impacting you?
Yeah, well, we have on average somewhere between 170 and 180,000 guests with us each and every day. So we're obviously buying a lot of commodities that support that. We buy probably close to 100 million bananas a year, about 500,000 eggs per week. So there's a lot of volume that goes in to support this business. But one of the things that we saw as we kind of crossed the year is a lot of those commodities not only flattened, but they've begun to come down a little bit. Obviously, we saw a lot of inflation occur in 22 and 23. And fortunately, we did the hard work during the pandemic to right our cost structure, which absorbed the vast majority of that inflation that came into our business.
You know, another question that people have is the demographic you're playing with here. You know, it's interesting. Another word I hadn't really heard before is new to cruisers. Are you getting recurring bookings here from die-hard cruise goers, or are you getting new people who are coming on board?
Well, on our loyalty base, for sure, we've seen about a 30% rise in repeat rates just here in the past year. So our loyal guests are very keen on sailing with us over and over again. But the rise in new to cruise and the rise to new to brand has been very impressive. And today, about a third of our guests are new to cruise, a third of our guests are first to brand, and about a third of our guests are loyalists. And we've seen a huge change in that shift over the past couple years. I think one of the other interesting facts is that the average age of our guests is also getting younger. 1 out of every 2 guests is now millennial or younger on our ships. And so we're also, the consideration for cruise has really reached to a competitive level with land-based. And the millennials are really seeking those experiences. And when you combine it with the best ships in the world, and going to the best destinations in the world, and us having our private destinations right off the coast of Florida here, that's generating a new wave of demand that we did not see pre-COVID.
More cash on hand, all of these new to cruisers. How do you see yourself expanding moving forward? Is M&A a potential to expand?
Yeah. Well, certainly M&A is always a potential. I think for us, we're very focused in excelling in our core and growing our core. I mean, we've been very deliberate about having the best brands and the right segments with the best ships and going to the best destinations. So we're investing quite heavily in our core, growing our core private destinations, and also a huge upgrade to our commercial apparatus technology-wise to make sure that we're effectively employing things like AI to help curate the experience, to take friction out of the guest experience each and every day. But I think when you kind of put that all together, there's always M&A opportunities. There's always ways that we think about how can we enrich the experience. And most of all, how do we keep our customer in our ecosystem? And that's through loyalty. That's by having the best brands in these segments so that our guests can trade based off of the different experiences that they're looking to do currently.
What do you see the competitive environment looking like, especially when it comes to kind of these newer firms popping up? You have this company, Viking Holdings, focused on the luxury market, expected to try to go public. Do you see more people entering the space, and how do you navigate around it?
Yeah. Well, Viking's been around a long time, and Torsten, who runs Viking, does an exceptional job. And I think it's good for us to have another public comparable that's out there. I think when we look at the competitive set, I think what's important is of course, we always keep an eye on what the other large cruise lines are doing. And it's tough to get into this business because the capital requirements are really, really high. So it's a high barrier of entry. But again, we're much more focused on delivering a lifetime of vacations. And you see, I didn't use the word cruise because it's a lifetime of vacations and experiences that we're focused on. And we're looking on how can we be as competitive as we can be to land-based vacation so we can close that gap there. I mean, if you think about a 1% share shift in land-based travel into cruise for us is worth 11 Oasis-class ships. And that's what we're focused on doing, is trying to close that gap. And that's the competitive set that we're really focused on.
Royal Caribbean CEO Jason Liberty, thank you so much for joining us, of course, on a very busy earnings day for you. Now, coming up next, we're going to go to the investment banking world. Barclays building out its transition finance as Deutsche Bank's investment bankers are stepping up in a big way. We'll take a look at both banks today on today's Wall Street Beat. This is Bloomberg. Now for some news across Wall Street, Viking Global, led by Andreas Halvorsen, raised more than $3.5 billion for its flagship hedge fund after opening it to new cash for the first time in a decade. That boosts the firm's assets to nearly $49 billion. Viking has a reputation as a solid performer even when peers are struggling during volatile times. The fund started raising in January of 2023 to replace client withdrawals and to capitalize on this market volatility. It will stop accepting new money on July 1st and will be closed for the foreseeable future, according to an investor letter seen by Bloomberg. And it's time now for the Wall Street Beat, from the hedge funds to the big banks. The big banks that are now making headlines are out of Europe. Deutsche Bank says they see strong momentum in investment banking, and Barclays say they need more money to go towards climate transition projects, and that will fuel some work for their investment bankers. Joining me now is Bloomberg's Catherine Doherty to discuss what is the play that Deutsche Bank is making here.
So Deutsche Bank is really relying on its investment bankers, its traders to grow their revenue, because what they're seeing a lot of the rapid rate increases weighing on the revenue from their core lending products. So their recent results are showing the strength in investment banking. It's reflective of what we saw from a lot of the U.S. banks in a return to capital markets for M&A picking up. So it's not only reflective of the strong momentum in the first quarter, which is really what they are talking about right now, but it's an indicator of the rest of the year. A lot of the executives, including Deutsche Bank's executives, the CFO speaking on TV, talked a lot about that expected momentum continuing into the next quarter and maybe even for the remainder of the year.
Deutsche Bank historically really big in the fixed income markets, leverage finance as well. What's interesting is fixed income trading actually not only came in better than expected, it came in better than the biggest U.S. investment banks in some cases.
Some of the biggest U.S. investment banks, yes. So that is exactly what they had called out as one of their strengths, which it has been historically, and we saw in the first quarter. And they're also calling out their strength from their income of advising on deals. So again, just another sign of pickup in deal activity and M&A.
How do we compare with what's happening from Deutsche Bank to what's happening over at Barclays after they reported?
So Barclays is really emphasizing what they see as an opportunity in middle market, these transition companies that are transitioning from fossil fuel to clean energy. What they're seeing is what they say as a need for the development of projects, and this fine line between being too advanced for VC investors and too nascent for these industrial investors. So it's really a fine line, but they don't see this as an issue. They see this as an opportunity. They've been hiring bankers to focus on this, to advise their clients, and hopefully they think that that will add to their fee income in future quarters.
As Bloomberg Opinion's Paul Davies says about Barclays, the investment bankers now should get a move on, as he says. Thanks to Bloomberg's Catherine Doherty for keeping an eye on the European giants. I'm Sonali Basak, though. That does it for Bloomberg Markets for the day. Volatile markets ahead. Stick with us through the close. I'll be joining you back then as well. This is Bloomberg.